I'm Paula Schaap, Markets Editor at The Deal. I'm speaking to Dinakar Singh, CEO of TPG-Axon. Dinakar, TPG-Axon just completed a very successful campaign at SandRidge Energy, and I wanted to talk about that. And one of the things that analysts and reporters often, finance reporters often compare it to is a nearby neighbor, Chesapeake Energy. So I was wondering if you could talk about the differences and the similarities between those companies.
Sure. I think from our perspective, both from an investing and ultimately as an activist perspective, I think the reason we focused on SandRidge, despite some of the historical commonalities, was because we thought there was better value, and we also thought that it was a company that was fixable. It wasn't so big and so complicated that it couldn't be put back in the bottle in that sense, I think. So we thought there were real things that could actually restore the company to health. Chesapeake is a much bigger, much more sprawling company. It's exponentially more complicated. So I think from our perspective, this was a bit more manageable situation. But the similarities were profound. Tom Ward, who ran SandRidge, came from Chesapeake, and he was a bit like the Robin to the Batman of Robin McClendon. And they were land guys, as it described the business. And in many ways,
what do you mean by land guys?
Well, if you go back to the 1990s, oil was cheap, and it was an era of oil being plentiful and cheap everywhere. In the 2000s, as the markets took off, there was this moment in time where there was just a sense of complete scarcity for oil. And there was a land rush to go and find new places and new areas to go and drill oil, and also then natural gas as well. And in many ways, I think the model for Chesapeake, which Tom Ward had as well, was the deal, the land and the deal model. It was all about doing deals and finding land, and then doing deals to monetize that land, and then finding the next land.
And in fact, SandRidge did a big deal, a couple of big deals. They both bought and sold. There was, I remember the deal where they sold Permian Basin assets at the end of last year.
This is a company that was a few $1 billion in market cap, and in their 6-year existence had done 4 or 5 major $1 billion transactions. When you're doing that much, it's pretty clear that the business of the company is deals as opposed to drilling. And I do think that our view has been and remains that in this era of energy, the world has changed. It's no longer enough just to go and say, aha, there's oil here, now pay me for it and let me move on. The companies that are successful today, because there's plenty of oil, but it's expensive and complicated. So the companies that are going to succeed are the ones that cannot just find resources, but are really good at being good operators. And
so when they did that $2 billion sale, was that something that sort of impelled TPG-Axon to come forward and say, wait a minute, we don't like this direction, now you've got this money, you have to become more efficient?
We had started becoming vocal in the month or two prior to that. And so I think in some ways the Permian sale coincided with or just preceded sort of the real formal launch of the campaign. But I think to us it was symptomatic of what we didn't like, which was a helter-skelter approach to the business as opposed to a strategy.
From the Schulte, Roth, and Zabel Shareholder Activism Conference, I'm Paula Schaap from The Deal.